Now, my next question is there are a few terms that are regularly used in commercial financing. So let's kind of try to make sense of some of them. Let's differentiate between the types of loans that exist for commercial finance. So there's agency loan, bridge loan, vendor take back. Can you please explain what each means and how commonly they are used in commercial financing, please?
Sure. So yeah, there are lots of different options in commercial financing. So you have, I don't know what a take back loan is, but or that term, but you generally have you have banks, you have non-bank lenders like who I work for now, which we're not a bank. We don't take deposits from consumers, but we are a financial institution. So we have other methods of financing our businesses. So you have, and then you have agencies like Fannie and Freddie and HUD, which rely on lenders like us to originate products for them. And they really act as what I like to say is insurance companies. And then you have balance sheet bridge lenders, which which we also do, but then there's lenders that just focus on short-term bridge financing.
And quick question for you, Nick, when you say you do, does that mean you broker those types of loans, or your firm actually has access to capital, which then lends it out as a bridge loan?
So in my case, Lumen is the direct lender. So so we are the lender. So we originate loans for our balance sheet, which is our capital. We originate loans for Fannie and Freddie Mac and HUD, which again, we originate for their platforms, and then we service the loans. So we're what's called a seller servicer, and then investors buy those loans, and so we can then go and make new loans.
Got it. Quickly on the bridge lending part. So let's kind of break it down. So bridge lending, it's kind of private lending as we call it here in Canada. It's separated into your good old neighborhood guy who lends you some money on a property you want to buy, but it also happens on the institutional side. Could you differentiate those two, please, if you may?
Yeah, it does. So bridge lending, there's bridge lenders that that's all they do. And then there's sort of financial firms that also have bridge lending available to them. But, bridge lending is the way it works generally is a shop will, set up warehouse lines with big money centers, big banks. And then they have to post a certain amount of leverage, a certain amount of, what they'll do is they'll get a warehouse line, they'll originate a loan, and they'll get leverage for that loan. So maybe up to 60, 70% of that capital. And then they have to fill in the gap. If they're doing an 80% loan and their warehouse line goes up to 60%, they'll only need to pony up 20%. And then they post, and then that allows them to sort of leverage up and do a lot of bridge lending. That's sort of the general model of your traditional bridge lenders. Does that answer the question? And
then, for sure it does. And then the vendor take back mortgage is where the seller actually finances the loan. The seller either has clear title on the property or in some form or way they're the financier of
I got it, understood. So seller financing.
Seller financing, exactly.
Yeah, sure.
Is that, you see that at all in the commercial space in multifamily?
You do. I mean, I don't see a lot of it on my side. I mean, we're, just based on, our client base and what we're out, it's kind of the business we're looking to do, but it happens. A lot of my clients have certainly taken advantage of good seller financing. Sometimes it's a great option if a deal doesn't pencil out for, say, an agency loan day one, because sometimes things don't pencil out, and sometimes the seller will say, hey, I'll give you, put 10% down and add to your business plan, and then in a year later we would come in and then maybe take it out after the person went in, executed their business plan, their value add, whatever they're doing, and then they'll refinance, pay back. But yes, I've seen it for sure.
And there's also a possibility of the buyer actually taking over the seller's mortgage as well.
Assumptions are very common. Yep, assumptions are common. If a seller has very good terms, maybe had recently refinanced the property or purchased the property, and it's got appropriate debt level on it, then yes, we do assumptions all the time.
Great.
It happens, yeah.